Everybody, welcome to part 2 of the Opportunity Zones Meetup. Our program tonight is focused on the topic of deal structures, and we're going to now dive into this particular topic. And in the first part of this, we're going to talk about what's called a grant of rights. So that we're kind of doing a little basic contract law. We're doing deal making, bargain making, and doing it in the context of opportunity zones. And if you have a question, shout it out. I'll repeat the question back to you for the benefit of the recording. Yeah, feel free to jump in anytime you want to at this point. So starting off with an opportunity, a lot of people, it's interesting that they don't, I guess, geek out on deals and deal structures like I do. I've been kind of a student and now a professor of doing deals, different transactions, different business structures for a long time, and looking forward to some teaching assignments I have later this summer. But an opportunity is where there's something new changed and now you can do something different. And it might have been there for a long time, but in this case we had a law passed that said that we've got a lot of money sitting in capital assets that we may want to incentivize people to liquidate those assets and move the money into a community that's in economic distress. And from that, the expectation is that there will be more economic activity, more economic growth. Some of these communities can do a really good job and catch up with the other communities, and some of them, they do an excellent job, may actually start to surpass other communities that were sitting pretty before this legislation was passed. So because of the change of the law, there are these tax incentives that say, put the money in here, let it set for 10 years, we'll give you some great benefits for doing that. It doesn't change the underlying business. A lot of concerns that have been expressed, and there was a blog post that I put up last week on my LinkedIn page where all these, I'll call it naysayers or ultra-conservatives were talking about what opportunity zones weren't and shouldn't be or whatever. One firm even saying that they weren't recommending anybody invest in an opportunity zone, which I thought was way over the top in terms of conservatism. But the point being is it doesn't fix the underlying deal. If the deal's bad, it's going to stay bad. Putting in an opportunity zone just means that you will not gain any benefit from that other than a deferral of your tax that you're trying to protect, but sooner or later you're going to lose it. You do get recognition within the law on how that tax loss is recognized, so it isn't all downside, but the primary purpose here is to put money in for 10 years, have a huge profit sitting there that you don't have to pay taxes on. And that's what we're going to talk about. So the investment is an investor, one side of a transaction, giving money to someone else. In this case, it's typically going to be a business or a property developer, but we are anticipating that communities will start putting together public-private partnership type of deals, which will be in an economically sustainable model, but will look more like a community project and may not be as readily identifiable as a business when it happens. But as long as it generates income and the income's large enough to pay back the investors any kind of rate of return, including even just a recapture of the original investment, it can be an opportunity zone, but the incentives are not going to be that high. So those are going to be more complex deal structures because it's going to require doing things a little differently in order to attract investors to put money in if they're looking strictly at return on investment. Now, we have a growing group of the investment community that are impact investors, people looking at social causes, trying to advance different purposes or things within their communities. And they're the ones who are going to take up part of this gap here where the ROIs are lower and because of the benefits they get from advancing a technology in some other fashion or advancing a cause or whatever they're doing. We're also going to see government agencies stepping in and providing some kind of either bond money, economic development grants, other types of programs that will complement the federal tax legislation to make it even more attractive in places where they're struggling and they may need more help to get going. But this is an opportunity, and an investment will take place. But what comes out of that investment is not limited to classical return on investment. You can have a whole span of different outcomes which are attractive to an investor that may be generated automatically by the success of a program. So deal structure. Deal structure is the terms and conditions of what's given up in exchange, money for something else. And it's typically a set of rights, contractual rights to participate in profits. It may be other things that we're going to talk about here that also have value or also serve as a reason for an investor to put their money at risk. But behind all this is that if there is a gain, then the tax incentives may make the difference. So commonly what a person does is they put money into a business. They get a share of that business, meaning that they get to participate in the profits and losses of the business over a period of time. And then the business is increasing in value at the same time while it's engaged in operations. So one of the confusing parts early on for a lot of people was they're going, well, I invest in the business, but the business is making money. What happens to that money? Well, that money is ordinary income to that business, and depending upon whether it's structured as a corporation or it's structured as a pass-through tax entity, you may have ordinary taxes paid year in, year out on that. And that's treated normally and has nothing to do with the tax incentives that we're talking about here. However, at the end of the 10 years, that business may have grown in value. And if it has, if it's appreciated, then it's sold or there's a cash exit of some kind achieved, then that gain in value between the original investment price and whatever you get back for that at the end of the 10 years, that gain is tax-free, and that's the core subject matter of what opportunity zones are about. Other things may occur that are complementary, that are perfectly fine. You may get a whole bunch of ordinary income and be happy with it because it's income. But it's not the sweet spot, so to speak, of opportunity zones. That doesn't mean it's not there, but it's treated differently. Now, from a tax strategy standpoint, if you're putting together your own fund, you may want to do a corporation by thinking that I'm accumulating my profits in there over the 10-year time period, and my net in terms of cash inflow, outflow is better in a corporate structure than it is in a tax pass-through structure. And yes.
Why is that?
Well, because as the money's coming in, for example, if I have an LLC,
it has to flow.
It has to flow to, the cash doesn't have to flow, but the tax liability has to go to the investor.
Well, the corporate structure allows you to keep the income in.
The corporate will have to pay its own tax rate. So it depends on a personal tax rate of an individual who's in a pass-through entity versus what the corporate tax rate is at the time. So there is no standard answer in here. Every case is unique. You have to go through a number of business modelings to determine why it might be better to put it in a tax-through entity as opposed to put it in a corporation. If you're not creating your own fund, that's not your choice except whether you invest in that fund or a different fund that matches up better with your personal tax capability. But the Sugar Beet District project, as we talked about earlier, we've set that up as a public benefit corporation. All the money is going to be trapped in there, and we're going to pay taxes at ordinary rates, at the corporate rates within that entity. But our goal is to push the value up of the entity as high as possible so that at the end of the 10 years, when that's liquidated, we may have the greatest potential tax gains. But that's in a real estate play, which may be different from a company like Jeff, who's doing one with a phone app, high tech, could be one of those high flyer types of things. And that may be totally different because there may be an even greater profit delta that will gain tax benefits. So it's something every person has to look at from both sides to understand that. And you may find if you're trying to raise money, you'll have a certain group of investors who have a preference. For one reason or another, their tax advisors told them only do these kinds of deals because of something else that's going on that is not common to everybody in the group. So,
but if you have a business and it retains, it's a real estate play, it makes income, it retains that income. Is that also the capital gain on that as well as forgiven also?
Let's take the question. So if you have a real estate project and it gains value over time, okay.
And it also generates income.
And it generates income. The income's taxed at ordinary rates. So rents, common thing in real estate, ordinary income. The thing is, as a business, you don't have to pass through all the cash that's generated. You typically will pass through enough cash that the individual investors can pay their tax liability. So you'll see often in an operating agreement for an LLC a provision that 25% of all the income will be passed through to the investors to assure that they have enough money to pay the tax liability associated with that income. But the remainder is held for growth or for reinvestment because you're on an aggressive track. And your goal is to try to reinvest that money to build the value of the business over time with post-taxed money in order to get there.
Right.
So again,
great answer. Thank you.
So you're welcome. But we've looked at all these models, and what we found so far is everybody's different. So there is no one answer for this, and your tax situation has to be looked at. And some answers are easy, and some of them are, sometimes they seem impossible. But that's common what will happen. Now, some of you may be familiar with revenue share, royalty type income. This is where you distribute a portion of the revenue that comes in the door before any costs are deducted. It's called above the line sharing as opposed to bottom line sharing. And this is done a lot of times in technology plays, but it's also done in some entities where people don't want to give up any voting rights. So a royalty right in a revenue share gives you ability to participate in the success of the business without necessarily voting or control of the business. And we're seeing some of that also where the investors really don't care to be involved in management, don't care to participate. They just want a good outcome at the end, and they want to sit back and watch everything happen, which is fine. That's one of their choices. So participation in management is coming up again and again as a deal structure element. There are certain people who want to vote. They want to be a contributing stockholder or member in an LLC, or they want to be a general partner, not a limited partner. And in that case, they're going to be looking for this in the proposal, saying they want to do this. Now, they may be a minority position, which means at the end of the day they have a vote, but their vote is trumped by everybody else's vote or the founder's votes. And even though they have a vote, it doesn't mean anything. It's a common thing for a minority shareholder to be trapped in an entity where their voice means nothing and the principal owners are doing whatever they want to do. But if it's important, then again, when you're putting a deal together from raising money side, what I typically will recommend you do is put together 3 or 4 variations of what you think you may be wanting to do and shop those to prospective investors and get some feedback from live candidates who may write a check to see what they're willing to do. And most of them are telling me they'll sit passively. They don't want to be involved in management. That's not something they want to get involved in. So we're seeing most of the deals I'm seeing are non-voting stock or non-participatory in management of some kind. One of the other things are indirect or secondary benefits, and this is an area that's kind of dear to me because a lot of times I'm working with businesses that may not make enough money, or the risk threshold that they'll ever make a great amount of money is not that high, but they still represent a good business opportunity. And the people who are most likely to invest in these businesses are people in their supply chain, vendors, sellers of components or resellers of their product, who are going to participate. So yesterday on the Sugar Beet District, we're talking about a 50-acre mixed use, and we started a conversation with a distillery in Tennessee where the person is aging to the point who wants to get out of the business, doesn't have a natural successor to the business, and we may look to acquire that business and move it into this as a new tenant. And as a tenant, they may be an investor in the overall project, meaning that the person who would take over the distillery would want to more than just acquire the business. They may also want to acquire part of this property development. because they can work together for a variety of reasons, give more influence on how they're positioned and where they're situated within the overall project. It's a secondary benefit. And in some cases, interestingly enough, the secondary benefit, monetary or non-monetary, is greater than the primary benefit of an ROI on the investment. And again, when you're out looking for investors, understanding that these secondary benefits are there, whether they're going to allow somebody to sell you more product and go down that path, or you're going to help the community, or you're going to advance a social cause, something that an impact investor, knowing that you're creating this kind of outcome or have the potential to create the outcome, allows you to rethink the deal, reorient who you're going to talk to, and do something different in your deal structure. So this is an area that I do a lot of work in, because a lot of the projects, isn't that they're bad, but there's so many unknowns that it's difficult to assign value or to do a reasonable cash flow projection going forward. So we start looking at other people who have other reasons for investment other than return on investment. There may be perks. You may bundle a particular investment with a giveaway or a premium or something else. So I worked with a tequila producer, distributor, and in their investment, if you invest so much, you get a case of tequila. And you know, you're thinking, well, okay, is this very expensive tequila because I have to allocate the entire cost of the investment to each bottle, or is this actually a bonus round within the investment? But once you get an investor who is looking at it from both directions, you actually have gained favor with them, because they're now considering other things, and you've broken them out of a mold of ROI only. Because in ROI only, investors will look at 100 businesses and they all look alike. It's like everybody was cut out of the same cloth, they're all clones. And this one's going to do 7.1% ROI projection, this one's doing 7.4. Okay, from an investor standpoint, you all look alike, and if you all look alike, then they're going to go with different criteria than ones that may favor you, such as I know the person, or I was in the industry, or I read a book about it once, or my planets are in alignment. I've seen all those as excuses for why they selected one deal over another. I would prefer to have a bundle that is so attractive that they're going to do the deal. We just got to get the paper put together. But in framing that, thinking through it, what can you add to a deal to make it more exciting? So some of you have talked about doing housing. We looked at a project in Lakewood where it was going to be about a 100-unit multifamily, and the question was, well, who's going to live here? And we were looking at everybody who was in a single-family residence that wanted to move out because of old age into a less maintenance type of facility. So we created a ring around the project, and we were trying to identify how many people would likely cross the line, want to move from single family to a multifamily as a form of retirement within the next so many years. We could actually go to them, ask them to invest in the project, and get a discount on their purchase of the property. So we're combining real estate with an investment in order to get to an outcome, and we had a very identifiable target, which made it easier to know who to talk to. So that ends the second part of tonight's program.